In this video, we're going to teach you a simple to understand option strategy that you can set up around support and resistance levels, but more importantly, through an understanding of how options work, we can show you how to squeeze a great deal of additional profit out of that same trade. I'm the head trader of SMB Capital's options trading desk here in Manhattan, and we train our traders to enter, exit, and size up in trades at the right time to take maximum advantage of the properties of options. This will be eye-opening, so stick around. I think you're going to learn an important lesson that can be very profitable for you. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so one of our subscribers made a suggestion for an options trade for a very popular trading stock, CMG, Chipotle Mexican Grill. This stock is particularly popular for options traders because the stock price is well in excess of $500, which makes the options commissions a minor factor in the trade, as they are at a fixed price regardless of the size of the stock that they're derived from. So anyway, this trader took a look at the price action of CMG this year and noticed that for the last half of this year, the stock seems to be finding support at the 720 area and had just recently traded up to its all-time high and backed off from the 855 area. And so what he suggested is known as an Iron Condor options trade to express his conviction that CMG will continue to trade in that range for the next 6 weeks or so. So let's take a quick look at what he suggested, and then we'll drill down to try to understand why he was suggesting this and what the risks and rewards of a trade like this are. So back on October 25th, CMG was trading around 792. And so this subscriber was suggesting that we enter into this options trade, which is known as an Iron Condor. So as you can see, the trade involves selling 5 of those 865 CMG call options expiring on December 6th, which is 43 days, about 6 weeks from the entry date of the trade. Then we're going to move up to the 885 strike, 20 points higher, and buy 5 of those calls. Then we're going to move down to the 710 strike and sell 5 of those puts, and then move down 20 more points and buy 5 of the 690 puts. So now this complete structure, a short call above the money, another one above that for protection, combined with a short put below the money, combined with another one below that for protection, that entire 4-legged combination is known as an Iron Condor. And in this particular case, you'd need about $8,400 of capital to enter into this trade. That's what your broker will require. Now, the width of an Iron Condor is defined as the distance between the short call and the short put. Well, in this case, that happens to be 155 points, which is a pretty wide distance surrounding the current market price of 792. The short calls at 865 and the short puts at 710, which makes up the 155 points of width for this trade. Now, here's what's really interesting about this option strategy. You see, at any point between 710 on the downside and 865 on the upside, you'll make money on this Iron Condor on expiration day. In fact, you'll make your maximum potential profit on this trade at any point between the prices of 710 and 865 on CMD on the expiration day of these options, which is in early December. Now, that's a good thing, as you can see, because as we mentioned before, CMG has been vacillating between 720 and 855 since early summer, whereas we make the maximum profit at any price between 710 on the downside and 865 on the upside, 10 points above and below the 4-month range of the stock. So you might be wondering, how can that be? Or more importantly, why at any price between those 2 short options will we make our maximum profit? Well, here's why. If you noticed on the Iron Condor that we just showed you, the 885 CMG call, the protective call, was bought at a price of $235 per share. Well, one of these call options contracts entitles you to 100 shares of CMG, and so you multiply that by 100 for each one, and we bought 5 of them. So if you do the math, we bought them for a total cost of $11.75. Moving down to the 865 call, remember we sold those, so we actually received cash in our account in the amount of $2,100. Now we also sold 5 of the 710 puts, which will require us to buy at any time before expiration 100 CMG shares for each put we sell for a price of $7.10. Well, we received $4.46 for those, and so if we do the math, you'll see that we received $1,503 for selling those 5 puts. Finally, we pay $3.08 for each of the protective 690 puts. And again, we bought 5 of those. So the total outlay for those 5 690 puts was $1,540. So if you add all those debits and credits together, you'll see that we actually receive in our account $1,615 when we first enter into this trade. Now, this statistically is a pretty high probability trade. In fact, it has a 79% chance of winning, and so most options traders will risk twice that, about 30-30, so that if the market moves outside of that range, and you'll see why in a minute, then the trade could be a loss, and you'd set your stop at around 32.30 in that eventuality. So now let's move forward to the day that the trade expires, and we can see if we just leave the trade alone and don't manage it, let's see what would take place. So as it turns out, CMG closed at 822.50 on December 6th, which is expiration day. So what is the outcome of the trade? Well, let's analyze it, breaking down each of those options. Well, the 885 call is worthless because no one is going to execute their option to buy 100 shares of CMG at 885 while it's trading at 822. Same for the 865 call that we sold. That's going to go unexercised for the same reason. As for the 710 put that we sold, well, that's also going to go unexercised because no one's going to exercise the right to sell their shares of CMG at 710 when the shares they own are worth 822. And so obviously the 690 put is going to expire worthless for the same reason. Thus, every option comprising the Iron Condor expired worthless. And so what we're left with is 4 dead options. And therefore, the original credit that we received for selling the Iron Condor in the first place, we just pocket that. That original cash that we received, the $16.15, we just get to keep that. That becomes, in other words, our profit on the trade. And that would have been true, by the way, at any price between the short call at 865 and the short put at 710, because unless the stock gets below 710, the puts expire worthless, and unless the stock expires above 865, the calls expire worthless. So anywhere in that 155-point range, the Iron Condor trader collects and pockets the entire $1,615 in premium. So we risked our stop of 32.30 for a 79% probability that we'd earn $16.15 of profit, and it worked out very nicely in this case. But what some Iron Condor traders don't realize is that there was a much more interesting way of playing this trade and squeezing a lot more profit out of what is already a pretty attractive trade. Now, before we get into that technique that I want to show you where you can dramatically increase the potential income that an Iron Condor structured like this can provide, I wanted to mention that we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 real-world option strategies that professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world like Warren Buffett use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with the stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now we just showed you a traditional way that an Iron Condor trade plays out, and that's fine, but there was a more advanced approach that could have been taken here with potentially better results, and I'd like to share that with you now. Now, this approach would start the same back in late October, where we were short 5 of the 885 calls and short 5 of the 710 puts, flanked by protective long calls and puts 20 points farther from the market. In other words, we'd start exactly the same way, but this time we're going to trade it differently. Remember, initially, the premise of the trade was that CMG would find support around the 720 area and resistance up near its all-time highs in the 855 area. So this time our plan will be different. We will maintain our stop of around $3,200 regardless, but if the market either sells off to the area of our presumed support or rallies up to our presumed resistance, we're going to add some capital to our position with the premise that the stock is likely to bounce at a support or likely to sell off at resistance. Now, you'll see in a minute why we would have a plan like that. So let's move forward to the morning of November 11th. You'll see that CMG has sold off 55 points and is approaching our support area of 720. So as we had planned, we're going to add 3 more of those put spreads down at the bottom of the trade, selling 3 more of the 710 puts and buying 3 more of the 690 puts. At the same time, we're going to close the call spread for 11 cents per option, as you can see, because we'll need to pay 94 cents to close the 865s, but we'll receive 83 cents for selling the 885s that we own. So the net cost of that would be 11 cents. So let's review what we've done here so you see the significance of it. You see, you'll remember when we first entered the trade, we entered the full Iron Condor and got a credit of $1,615 for the full Iron Condor. So if we laser in on the 2 puts, you'll see that for just that side of the trade, we received a credit of $690. Now, if we focus on what we're doing now on November 11th, 17 days into the trade, after CMG sold down to 737, you'll see that for selling just 3 more of the puts, we're going to receive $954. That's a 38% more credit for 40% fewer spreads. So now, why did this happen? Well, it happened because the 710 put value got a lot greater as CMG sold off and started to approach that put. The market started to think, hey, maybe the right to sell 100 shares of CMG at 710 is worth a lot more than we originally thought when it was trading up at 792. So we'll need to pay this guy a lot more if we want that right, because who knows how low CMG is going to go here. On the other hand, the 690 put is also worth more, but it's farther from the money, so it didn't increase as much in value. So as it turns out, we sold 5 put spreads for $1.38 at the beginning of the trade, but now we can sell them for $3.18. So no wonder we only need to sell 3 of them and still get away with receiving more money than we did for the 5 original put spreads. Now remember, the same time we are closing the call spread. So let's break down what we did here and why we did it. So you'll recall that on the call side of the Iron Condor, we received $1.85 for entering the trade. Well, now we can close that side of the trade for a debit of 11 cents. Why? Because just as the puts grew in value since October 5th when we first entered the trade, the calls drop in value for the opposite reason. Now the market's starting to think that the value of being able to buy CMG shares at 865 and 885 when the stock's trading at 737 is not very much at all, because those prices are way above where the stock is trading now. So the value of both the 865 and the 885 puts plummeted. So we can buy back the 865 put really cheaply and also sell the 885 put and get a little bit for that. And the result is really very good for us. As you can see from the calculation, we made $870 from the call side of the trade. Now, you might ask, why did we do that? And the answer is that options income traders are always looking to reduce risk. We made more than 90% of the potential profit from that spread by closing it. If we had kept it open, we were taking the risk that CMG would bounce, and now the short call at 865 and the long call at 885 would both be worth more, and the opportunity to close them very cheaply could disappear. So the extra 11 cents of profit we could have conceivably squeezed out of the trade was just not worth the risk of that strong bounce happening. So now, after we made that transaction, here's our position. We have no call side, we cash that in, and now instead we have an 8-lot put spread on the put side instead of the original 5-lot. Okay, so now we'll move to November 26th, and you'll see that the premise of this trade, that CMG would hold support at the 720 area, did in fact play out as we wanted it to. And so now with 11 days left in the trade, because these options, as you'll recall, expire on December 6th, we can close the trade at a terrific profit. Now I say that because if you notice, the 710 put is now trading for 63 cents and the 690 put is trading for 57 cents. So if we buy those 8 puts to close that 710 position and sell those 8 puts to close that 690 position, the cost would be 6 cents for the spread. So let's understand the implications of that. So you'll all recall that before, when we just focused on the put side of the trade, we noticed that we had received a $690 credit for the first 5 lots that we sold. And then remember, when we sold the additional 3 lots, we received another $954. And then of course, to close all 8, you can see the calculation of that, which comes to $48 to close them all. So now pulling it all together, you can see that when we add up all of the credits we received from the original 5 and the additional 3 put spreads and the original 5 call spreads, and then subtract the cost of closing those sides, you can see that our total profit on the transaction was $2,466. And if we compare that to the original trade where we just put the trade on and took it off when it expired, you can see that we made in excess of 50% more profit just by playing the support level on CMG and adding substantially to the potential win by strategically adding risk when the market neared that support level, which blew up the value of those put spreads. So if we got a bounce, we'd significantly enhanced our profit potential. And so by combining some simple technical analysis with options knowledge, we were able to design and execute a much stronger trade than the original simple Iron Condor. So I'd like you to take away a few things from this video. The first one is that you can use the Iron Condor trade to express your opinion about support and resistance on any stock that you follow, recognizing that if either support or resistance get broken, you'll struggle to make profit on the trade. Although with repair strategies, we can discuss it another time, we can still win those trades with some skill incidentally. But more importantly, if you can get a grasp on how options work and how to leverage those properties to substantially increase the potential of what is otherwise a simpler trade, then you can gain an edge in your trading that you might have never dreamed possible, but with a little knowledge, you can implement successfully. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And one more thing I'd like you to do is please go ahead and click our subscribe button so you don't miss any of our trading videos that we produce for the trading and investing community. And while you're at it, please add your feedback in the comments section for what videos you'd like us to produce next, as well as what you found helpful from this video. So from all of us here at SMB, trade well.